Welcome to the class today under the head Institutional and Managed Portfolio. We will be studying performance evaluation of managed portfolios. How the in your investments and other things are managed, that is the subject today. So let's first know the objective of today's session. We'll discuss initially the various concepts and methods of computing portfolio return. Now, just make a note, portfolio means I have purchased different shares or other assets and build up a portfolio, generally equities, debt, etc., and different type of shares. Then we'll study the distinction between performance measurement and performance evaluation and the primary components of the performance. So there is one thing is performance measurement. Then you have to evaluate it, how it has performed vis-a-vis others, and then what are the primary components which are measured to evaluate the performance. Third, we will be learning about, we'll understand the concept of benchmark portfolio for comparison and evaluation. Then we'll go to explain why a portfolio earned a certain return over a particular time period, which is also known as performance attribution. And finally, we'll discuss some problems or shortcomings or limitations of performance evaluation because of various reasons. So this is the things which we are going to study today. Okay, so ready? So we go to the introduction. The main reason for selecting a mutual fund or investment, because as an individual I am not well equipped to manage in today's fast changing world my portfolio. So I give my money to some fund managers. They are competent, so they know how to diversify, and when I need, they can give me my money back with a return. So they are called professional portfolio managers. They are trained in the technique of security analysis so that they can choose which securities suits my risk and return expectation or risk appetite, and devote their full time for meeting the fund's investment objective. We have earlier covered that whenever I build a portfolio, there should be some objective. Suppose I am building a portfolio for 5 years down the line, my son or daughter will be going to the college. So there is an objective that this investment should be growing at this pace or something like that. So this is very investment objective. It's a very important thing. And this, once we know, then it becomes easier for the professional fund managers to choose some securities and to hold it for a particular time frame. Okay, and they keep monitoring whether this is doing well or not, or they should change it with some other securities or not. As an example, I can tell you, suppose I have built up a small portfolio with ITC, Hindustan Lever, Tata Steel, and maybe a bank, ICICI Bank. Now, these are only for educational purpose, no recommendation to buy any shares. Okay, this is a disclaimer. So now I may find on the way after 2 years or after some period, ITC is not doing well. So I can change, I can monitor the performance of the portfolio, and then I can change from ITC to I can buy some other stocks, or I can replace Tata Steel with JSW Steel, or I can change the bank, or I can decide, no, I will not invest in this, let me go and invest in pharma sector or IT sector, like that. So constant monitoring is required, looking at the investment objective. It is necessary to evaluate the performance of the fund. Now, why evaluation? Evaluation is basically comparing with others. Okay, some fund managers perform better than others when market was in uptrend, whereas some others focus on reducing volatility. Volatility means my stocks or my portfolio doesn't swing too much. That is very tension. So you should manage in such a way that there is a reduced volatility. So that means there is risk is less, or I manage the risk. So they show better performance when the market is not doing well. When the time is tough, they are generally better performing. Whereas the first person, fund manager, is maybe a little aggressive or goes with the market and it's better when there is an uptrend in the market. So we'll discuss various methods of computing portfolio returns, component of investment performance, and pinpoint the difficulties. Please note, we'll pinpoint the difficulties in risk-adjusted measures because you are taking a risk whenever you're investing in equity and other thing. Have you not taken that risk? What would have been your return? And if you have taken the risk, for that risk, what is the additional return you are getting? That is the concept of risk-adjusted measures of portfolio performance. So these are the things which we'll be covering as we proceed. Let us begin by distinguishing performance measurement and performance evaluation and explaining the methods of computing portfolio return. So what we are going to begin with, we'll distinguish what is performance measurement and what is performance evaluation. Then I'll explain methods of computing portfolio return. Okay, let's move. Now, methods of computing portfolio return. Now, performance measurement, as you can see, it's just an accounting function. I had 10 lakhs. Now the value of my portfolio is 15 lakhs. So 5 lakhs return in a period, say 1 year, I have got. So 50% return I have got. It's a plain and simple thing. Anybody can understand, okay, I have invested 10 lakhs. In 6 months later, it has become 12 lakhs. So 2 lakhs is my gain on 10 lakhs investment. So if I tell you the percentage is 20%. For 6 months, you can convert it to annualized return, it will be 40%. Portfolio performance is generally, now this is the measurement part is over. But when I am looking at the performance, I generally evaluate over a time interval for at least 4 or 5 years with return of several sub periods in between that, within the interval like monthly or quarterly, so that there is an adequate number of observation for statistical evaluation. I'll compare this with a student's performance. When we'll try to see a student when he's graduating or going for MBA and other thing, how did he do in class 10? How did he do in class 12? How did he do in graduation? How did he do in between class 11 May and etc. Then we know that whether it's a consistently good performing or he did well in 10 when the things were okay, 12 May he went down or he went up because the subject was in his favor or whatever reason may be, or in subject he could not understand, the marks went down, and then in graduation he got his favorite subject, so he was trying doing well, like that. So if you compare this with the investment, it is something like that. Every year or period there is some return, but when I will evaluate a performance, I will look for a longer period. What it gives you, whether like student, whether he's a consistent or not, or is a fluke. Suddenly something has happened, he has given good marks. No. So I will evaluate a portfolio over a period of time. Ideally, 5 years is a good time, 5 to 7 years, when you are talking about investment. These are not technical trading or trading. These are investment. So when I am investing somewhere for 5 years or 6 years or 10 years, I would like to see the consistency of the performance of the fund manager. I hope I'm clear. And so there is whenever I am measuring over a period of time, say quarterly return, over a 5 years period, I get 20 data points, 20 returns each quarter. So I can now statistically check whether he's consistent or he has gone up, came down, gone up, came down. So he was moving. His performance was not consistent. Sometimes he was losing money, sometimes he was making money. This statistically I can evaluate the performance of the portfolio. So quick wrap up. First two, performance measurement is a very clear cut arithmetic. 10 lakh I have invested. After 6 months I have got 12 lakhs. That means 20% I have gone. 2 lakhs I have got. That is 2 lakh in 10 lakh is 20%. If I make it annualized, I got 40% return. That's simple arithmetic. But when it's come to performance evaluation, portfolio performance evaluation, I need a longer time horizon because investment is for a longer period. And in that long period, there are many quarters. In some quarter he may do well, some quarter he may not do well, like that. So I would like to see whether he is consistently performing well. If market has gone down, he might have also gone down, but not that much. That will give you confidence in the fund manager, and you know that you are properly invested. Otherwise, you have to rethink whether you remain invested here or not. Now, the third is the calculation of portfolio return is simple when there are no deposit and withdrawal. Yes. Now, this is, you can make out that suppose you have given 10 lakh deposit, and after 5 years you are checking what is the return you are getting. But if you are putting 5 lakhs, then sometime after 2 years you have got some bonus or something, you have put another 1 lakh, then another 1 lakh, and then after 5 years you are going and saying, okay, I have given 2 lakhs, 1 lakh, 1 lakh, 4 lakh. In seventh year, it has become 7 lakhs. Now, this becomes a little delicate thing to calculate and compute what is actually the return I am getting, because I am investing at different time frame. But I am closing or withdrawing the money at a particular time, 7 years. So maybe the first money I have given now, which I am taking after 7 years, the second money which I have given after 2 years, I am taking after 5 years. Third money which I have given after 4 years, I am taking after 3 years. So in that case, market value of the portfolio in the beginning and the end of the period are determined by computing the portfolio return, because my calculation requirement will be different. It will not be as simple as I have given 10 lakhs, it has become 12 lakhs in 6 months or 1 year. So this is the return I have got. It will not be that simple, because time to time you are making investment there, and that is giving some different return that will give if you calculate. With this, I move to one simple example. Now, calculating an assumed portfolio return, share A, B, C at the beginning, as I was telling you, 50 number of shares I have purchased at 100 rupees, and the portfolio, the value for me is 5,000. Similarly, A, B, C, D, total value at time 0, at when I am investing at a time, it is 50,000. Now, at the end of that period, suppose 2 years I have kept it or 1 year I have kept it, and then I find that ending May, I have my value is becoming, market price has changed to 140, 110, 80. So portfolio value is now 76,000. So what has happened? Investing 50,000, after a period, I have got a 56,000 back. So that means 76,000 minus 50,000, 26,000. This will be 26,000. This will be 26,000. I have got investing 50,000. So that is 52%. Suppose if it is a yearly, then annualized return is 52%. This is what is the simple calculation of the portfolio return, where there is no investment in between. One time investment and then you are sleeping, or you are just monitoring. You are not buying any more or selling anything in between. You are checking everything at the end of a particular period. कि अभी कितना पैसा हुआ मेरा. So performance measurement is simple, as you can make out from here. It is simple arithmetic. You have to just minus from the capital. Whatever the return you have got, you have to divide by the capital, and you will get the percentage return. It's simple. Now, performance measurement becomes difficult when a client adds or withdraws money from the portfolio in between. Suppose I have invested 50 shares, now I have sold those 50 shares in between, and I have bought something different, or I bought some other shares, then it will be difficult to calculate in this simple manner. I have to use some statistical or sophisticated formulas to calculate my return. Okay? So this, I will keep it for a time. You can see here that my initial investment was 50,000. After a period, portfolio value at ending is 76,000. That means 50 and 76, that is 26,000 I have made money on an investment of 50,000. So my return is 52%. It's very simple. Portfolio measurement. Problem starts if in between this beginning and ending, I have bought something or I have sold something. Then at the end, I have to take into consideration all those inflows and outflows to know what type of return I have delivered over a period of time. Those who are familiar with mutual fund, they know the fund manager manages a fund, and many people are entering the fund or investing in the fund in between, and many people are withdrawing in between. But you are getting a data at the end of a month or fact sheet or some period that this is the return the fund has given. So that is a little more sophisticated way you calculate the return, right? With this, I will come to the next slide. There is two methods which are often used by the fund managers or financial analysts and mutual fund analysts or whoever is analyzing the performance return and evaluating the performance of particular managed investment. Managed investment, why? Because some fund manager is managing it. It's your money. Fund manager is using his expertise to give you a return. For that, he charges a fees. Now, first method we will discuss about is value weighted rate of return. Value means if I am investing in rupee, then it is rupee weighted. If I am investing in dollar, it will be dollar weighted, like that. It's also called internal rate of return. The interest rate that equates. Now here, internal rate of return, what is that? Suppose I am investing, I'm not giving from this example. I'm just telling you. Suppose you are investing in somewhere 100 rupees, and then you are again investing 200. Sometimes you are investing 500. Sometimes you are investing again 300, and then finally you are getting X amount of money. Now, if I discounting this method 1 plus R, देखिए जो हम I have divided. This is process is called discounting. I try to see what is the today's value, at what rate it equates the today's value. That means that is the internal rate of return I have earned. I repeat it again. Suppose, let us take this example. Portfolio market value of 100, I am investing 100. In the middle of the quarter, I deposit 5 lakhs. Money, I am cash out. I am not receiving money. That is why it is minus. Okay, at the end of the quarter, value of the portfolio is X03. Suppose I am encashing it. So now I have got a return of R. So the formula is here. I discount first year 1 by 1 plus R, second year 1 plus R to the square. If it is third year, then 1 plus R to the power 3. This is the R is my return, weighted return I am getting. And I find out the R with the mathematical calculations. Now here the R is minus 0.98 because my portfolio was 100. I have added 5, money it has become 105. But after the quarter, it is 103. Money it has lost 2 rupees or 2 lakhs. It has lost 2 lakhs. So I have invested 100. Apparently, if it was one time, that means 100 has become 103. But that's not the case. In between somewhere, at the end of the middle of the quarter, that means 45 days after the first investment of 100, I have put 5 more. So now my capital at stake is 105. And then when I am checking at the end of the quarter, I am finding it has become 103. So now naturally I am questioning it, what is the return I am getting? So this you go by this method, internal rate of return, and then that is return is R, 1 plus R, first is 1 divided by 1 plus R, second is 1 plus R to the power 2 square, third is R to the power cube, fourth will be R to the power 4, like that. It is quarterly, it can be annual, depending on the period. Here it is half a quarter period. So this R is now, if I calculate it, is 0.98 which is a semi-quarterly. That means for 45 days my rate of return. Now this can be converted into quarterly return with the help of following equation. This is the equation. You will get the quarterly return is minus 1.95. It's something like doubling. 45 days में अगर हम 98 पैसा lose किया है, that means in 90 days I have lost, full quarter में I have lost double of it. It is that is what it is showing. Okay, so this is what is the calculation method. I told you it is a little sophisticated method, but it will always happen that you will be putting some money, you will be withdrawing some money, but you want to see at the end of the period what is the return you are getting. So what happens actually, the analysts and other things, and you since you have to check the report the fund manager gives you, that what is the actual return they have earned on my money. If you look at the first quarter, maybe he was making money, that is why I have put in 5. But when I see that I have put total 105, by the end of the quarter, it has become 103, means I have lost 2 lakhs rupees. So now mathematically I can calculate what is the return I am getting. Maybe this will go up later on, that we do not know. But as of now, with the available information and data, we are making a loss of 1.95% per quarter. Now, if you multiply this by 4, it will be annualized. With this, I complete the value weighted rate of return. It is in rupee. It can be in any currency. We'll talk about rupee only. Next comes time weighted rate of return. Time weighted rate of return is the weighted average of internal rate of return. Now just note it here. Time weighted rate of return is the same weighted average of the internal rate of return. That means first quarter mein what is the return I am getting, second quarter mein what is the return, I will be averaging with the weighted by the length of the sub periods. That means I am not taking the whole year, I am taking quarter, what is the quarterly return, and I take the weight. That means my portfolio value in the first quarter was maybe 105. How much return I am getting there? This is, I take the weightage and I'll find out the IRR. Maybe my portfolio was 110 and I have got a return something like that. And then maybe my portfolio was 100 back because market went down, and then again market went up, portfolio became 110. So what return I am getting? So I will be length of the period का weight देके I will take the weighted average rate of return. That is called time weighted rate of return, right? Now here is the big problems. So time weighted rate of return is a geometric return actually. There are two things averaging you do: arithmetic average, geometric average. So this is a geometric average you use, which gives more accurate figure. In this method, it is geometric return measured based on periodic market valuation of assets is time weighted return. The equation for the time weighted rate of return for 4 sub periods is annual return. Now I am going for annual return here. Everything is quarter, R2, second quarter, third quarter, fourth quarter. That is why it is to the power quarter, 1 quarter. Minus 1 was my principal, so I get the annual return. Okay. Let us now make a quick comparison of value weighted and time weighted return. So you have understood, in time weighted what I do is that each quarter mein what is my return and the value of my PA, I keep weightage deke, I multiply and then I find out the time weighted rate of return. This is another way. In the first one, we simply read the rupee we invested. What is the return? We discounted it with the R and found out R. What is R? Here also you have to find out the R when you know the what is the money you have got, what is the money your portfolio value. All the data if I give you, you can find out the annual return by putting the figure here. Now let us see. A portfolio of 50 lakh. A portfolio of 50 lakh declines to 25 lakhs in the middle of the quarter, at which point The client deposits 25 lakh of portfolio management firm. Note, before I put in my 25 lakhs, my fund has already lost 25 lakhs. That means 50% of the value. After that, I am giving again 25 lakhs. So I am out of cash. That is why it is negative. So at the end of the quarter, the portfolio has a market value of 100. Now at the end of the quarter has a portfolio value of the 100. So what has happened? At the end of this quarter, my value came down to 25. I have added 25. Now it is 50. That has become 100. So it is 100% return. 50 has become 100. But before that, if I look at the quarter, I lost 50%. Okay. Now, if I take the weighted average, value weighted average, quarterly value weighted return, this is the formula I showed you in my earlier thing. This is the formula. Sorry, this was the formula. So, using that formula here, I am getting quarterly return 18.6. Sorry, semi quarterly. Quarterly value weighted return is this 40.66. But now it is time weighted me if I go, then my portfolio return is 1 minus 0.05 and 1 plus 1, 100%. Finally, I have this quarter I have lost 50, this quarter I have gained 100. My initial was 1. Okay, this is a formula. So to the power half, because half after the quarter, semi quarterly, return is 0% actually. So each rupee lost half its value in the first half and remaining half doubled in value in the second half. So the 50 lakhs which became 25 lakhs also became 50, and the 25 lakhs I have given that has also become 50. That is why portfolio value is 100. But if I look at the first 50 lakhs, it has a negative return initially and then it has a positive return. So if I take into time weighted basis में, then my return is 0. Each rupee lost half its value in the first half and the remaining half doubled in the value in the second half. Thus, time weighted return is a more accurate measure than value weighted return. Okay. Thus, time weighted return is a more accurate measure than value weighted return, because I am taking into each quarter kaisa return aa raha hai, and then I am trying to find out the annualized return. A dollar, actually it will be rupee weighted or dollar weighted return, is strongly influenced by the size and timing of the cash flow. So if I have given 5 only here, things would have been different. If I have given 100 here, things would have been different. So how much money I will give, fund manager does not know. So you cannot judge his performance by how much money I am putting. But once I put the money, how he is managing the money, that is what I have to look for. Their time weighted return is much better method to evaluate a portfolio's performance over a period of time. Right? So the formula is like that. It's a geometric progression, quarter, with value of my assets to the power 1 by 4, because I'm taking each quarter. So this is the quarterly. How to make a quick comparison is that I have shown you that 50 lakhs became 25 lakhs. Then I have put another 25 lakhs, it has become 100 lakhs. So if I go by my rupee return, weighted return, then I think that okay, 40.66% return I have got. But if I take the time weighted return, then I'll find that I have not gained 0% I have gained. Okay. Now, Performance of a mutual fund can be evaluated by using the beginning and end period net asset value. We have studied earlier the net asset value of the fund. So it is just like I have invested, as I showed you in the earlier slide. Yeah, I have invested in A, B, C, D, four stocks. So the value of my market value of my investment is say T minus 1, and it becomes at the end of the time T. So this is my return. So if I've invested 10 lakhs and it has become 12 lakhs, then 2 lakhs I have gained. If in between they have given some dividend, that I have gained, and also the capital gain of the NAV as a percentage I have got. So the one period rate of return for the mutual fund RP is defined as the change in net asset value plus its cash disbursement and capital gains disbursement which I have given you as a bonus, or as a not bonus, as a capital payout. Okay, net asset value of the fund are adjusted for bonus and rights. The funds are ranked in the order of performance. So if you go and check, suppose Value Research or Morningstar, these are various sites, they give the return of different mutual fund. They generally rank them depending on the category of mutual fund investment objective. They rank them depending on their performance. Okay, so generally this is the way we perform net asset value. Change in net asset value, we add the dividend, whatever they have given in between, and etc. And if they have disbursed any capital gain or not. If they have disbursed, that should be added to find out that okay, total इतना कमाया था, उसमें dividend दे दिया था, उसमें capital gain distribute कर दिया था. So I have to take that into account when I am evaluating the performance of a mutual fund. That's it. Now, I will rank depending on the performance of the fund. Suppose X fund has done this return, Y fund has this return. So from top to bottom, best return, second best, third best, like that, I will rank them, or the most of those who provide this information, they rank this managed funds, how they are being managed. The differential return, now you can understand some fund managers has earned better return, some has less return, etc. This differential return earned can be for the risk they have taken. Suppose somebody has taken more risk and it has worked for him, he might be giving a good return, but he has taken more risk. Money could have gone down also. That is why returns must be adjusted. This is a very important thing we are entering now. Adjusted for the risk before making any comparison. So risk adjusted return gives an idea of whether the return earned is commensurate with risk incurred. Suppose you are taking risk, let us say, taking two risks, then you will be getting a particular return. If you're taking 4 risks, you will be getting a higher return. But at the same time, there is a probability of loss also. So what type of risk you are taking, that's also very important. And when I know that, okay, given this risk, you have earned this much of money, that is my risk adjusted return. Okay. Suppose I would have kept the money in the bank, I would have earned 7%. I have given the money to the stock market and they have given me 13% return. So it is not the 13% return I have got. 6% I would have got in any case, if my money in the bank. It is the 7% extra return they have given. It is their contribution because they have chosen a right product, etc., which will be coming now. So what is risk adjusted rate of return? The performance of a fund should be assessed in terms of return per unit of risk. So if I theoretically say that I am taking 1 risk, so I should be getting 2 return or 1.5 return. But I am taking 2 risks, so I should get accordingly return. This is very important. then you know how much risk you, because if it is there is an upside, there can be downside also. So then you know as an investor how much risk you can take. Or if you're a fund manager, you need to know the client, what is his risk appetite, we call it. How much risk the client can take. If he can take three quota of risk, then you can invest the fund accordingly and give him a return which is adequate for the risk he is taking. And if somebody is ready to take a lot of risk, he will be expecting a lot of return. I'll give an example here. You might be hearing a lot of startups and you do not know whether it will do well or not. People are investing. They're taking huge risk, but they're expecting huge return. Okay, but if it goes for a toss, then their whole investment is gone. In fact, in this startup phase, out of 10 investment of mine or somebody who's investing, maybe one or two will click and give him adequate return, which compensate for all the losses he is making for the rest of the 8 investments. So this is the concept of risk. Now, the relevant measure of risk is systematic risk or market risk. This we have studied earlier, the beta. Beta is how signifies the relationship between covariance and the variance of the market. If market moves one, I move more than market, my beta will be higher. I move less than the market, my beta will be lower but more than zero. And I move as per the market. इसको हम explain करेंगे. Suppose market gains by 15% and my portfolio also gains by 15%. That means beta is similar to the market. That is, we call it 1. But suppose market has gone 15%, my investment has gone 18%. That means I have, for the risk I have taken, I have earned higher return. So this is beta is greater than 1. And the reverse is beta is greater than less than 1. When market is getting 15%, but I am getting 12%. That means I am more conservative than the market. So my return is little less, not negative, little less. This you have to understand the function of beta. The systematic risk, I will not take much. I am happy with the lesser return. Very good. You want to take risk, you invest in that type of portfolio, enjoy better return, or if it goes down, you are ready to take the risk, so your investment goes down. Now there are two well-known measures of risk-adjusted return are used for managed portfolio का risk-adjusted return देखने के लिए. One is called Sharpe ratio, which is developed by William Sharpe, and another is Trainer ratio. Mr. Trainer, he has founded this formula. So first, let's go to the Sharpe ratio. You remember the risk-free rate? We studied it in the capital asset pricing model that everybody wants to, at least the risk-free rate they should earn. Anything more than that, they should expect from the market. So now here, what they're saying is that if my return from the portfolio is RP and risk-free return is RF, then RP minus RF is my return. RP minus RF is my return for the portfolio. So this is return minus risk of return divided by portfolio standard deviation. This is SD of the portfolio, standard deviation of the portfolio. That means portfolio कितना ऊपर जा सकता है, कितना नीचे जा सकता है, depending on the market. That's a simple way to understand it. It is supposed to give 15% return, but sometimes it is going to 17, sometimes it is coming to 13, sometimes ये, but आस्ता आस्ता बढ़ रहा है. Now I'll take an example which makes it a little easier for you. So the Sharpe ratio, once I tell you again, it is the return more than the risk-free return I am getting. This is return minus risk-free return divided by portfolio standard deviation. Portfolio standard deviation is portfolio risk. That means for every unit of risk, what is the return I am getting? For example, let's assume that we look at a 1 year period of time where an index fund money, Nifty, who are investing in Nifty or Sensex like that, Nifty 50. Let us assume that index fund has given a return of 11%. So that we call market return, because that's the market where different stocks are there selected by the pundits, and that has given a return of 11%. That's the market return. Now, treasury bills as the government of India guaranteed bonds. They are 6% money risk free. If I invest there, I know there will be no default. I will get my money back. So that gives a return of 6%. Now, if the standard deviation of the index fund is 20%, that means it moves 20% this side, it moves 20% this side. Then Sharpe ratio is computed as follows. That is, 11 is the market return. I am getting index fund mein, minus risk-free rate divided by standard deviation 0.20. This answer will be 25. That means Sharpe ratio is 25 by 1. Okay. What does it signify? It signifies is for the standard deviation I am getting 25 return. Clear? Now let's come to the let me repeat once more this one, the example. Let us assume that we look at 1 year period. Okay. Now, index fund return is 11%, that is market return. Treasury bill earned, that's a safe instrument, Government of India. It will never default, it can print money and give it to you. So that is your risk-free rate, 6%. So 11 minus 6 is your return, 5%. But for that, what risk you have taken? This 20% deviation. Deviation मतलब आपका टारगेट से इधर हो जाता है उधर हो जाता है. It moves away from the target 20%. So if I divide it, that means every percent के लिए I am earning 25. It signifies that. When you compare this with another fund ka Sharpe ratio, then you can tell that this fund is better or wrong. Sorry, excuse me. So now we'll go to trainer ratio. Trainer ratio measures the returns earned in excess of those that could have been earned in a risk environment. Same. Return of the portfolio minus risk-free return. Here पर Sharpe ratio and trainer ratio is taking the same measurement, but they are dividing by beta of the portfolio. But how portfolio is linked to the market. Standard deviation was how with the market my own portfolio is moving this way, that way. Here, if market moves, how my portfolio moves. That is beta. Right? Realized portfolio return RP more than risk-free rate RF divided by the beta of the portfolio. So the absolute risk adjusted return is here is trainer ratio में जो return हमको मिल रहा है, plus if I add risk free rate, then I get the absolute return. That means if risk free rate is 6 and my ratio is 9, then 6 and 9, 15 will be my absolute risk adjusted return. Okay. Now, for instance, example makes things clearer. For instance, assume two portfolios A and B. Respective return is 12%. A has 12% return and 14% with beta 0.07. A has a return of 12%, B has a return of 14%. A has a return of 12%, B has a return of 14%. Risk-free rate will be same for both. Now here I am dividing by standard deviation. That means A portfolio, how much it moves this side or that side. I am not comparing with index or the market return. In trainer, I am comparing with I am doing the same thing. So I get risk adjusted return kya hoga? This is trainers. Okay. Beta, portfolio beta. This is not standard deviation, it's beta. 0.7, 1.2. So I am getting in portfolio A में 4.25 return and trainer ratio, and TB may I am getting 4.17 ratio. Risk adjusted. Now I am adding the risk-free rate kitna tha? 9. That means portfolio has given a return of 13.25, A portfolio, and B portfolio has given a return of 13.17. So this is I am getting absolute risk adjusted return. Okay. I'll repeat it again. Suppose there are two portfolios, trainer formula use करके. A has 12% return, B has 14% return. आपको लगता है B अच्छा क्या है? But if I adjust for the risk and then the beta, the risk the portfolio manager has taken B, which is higher, that is why risk adjusted return is lower. That means the risk he has taken, he could not deliver that much of return. Whereas with less risk, A portfolio has given me a better return, marginally. It's clear? Here I have taken more risk, but could not give a better return. But here I have taken a less risk, systematic risk, beta is systematic risk, but I have given a better return. So now I add with the risk-free rate to milna hi hai humko. So I get a better return in portfolio A, I get a lesser return in portfolio B, which is both are risk-adjusted return. You have to go through it once. Just go through it. You will have better clarity. Portfolio A, portfolio B, less risk, more risk, better return, not so better return. So the absolute return better in A, absolute return not so good, a little less in B. So when you point out the risk adjusted rate of return, you have a better understanding of risk versus return. That means if portfolio manager of B, he has taken risk but could not deliver. Whereas portfolio manager of A has not taken that much of risk but have delivered better. That is why the performance of two fund managers will vary. That's what I was telling in the last, before some slide web. Now, for your information, I just want to share a poorly diversified fund will rank lower according to Sharpe measure than trainer ratio, because the less diversified will have greater risk when using standard deviation is used. Naturally, if you less diversified, suppose you are putting Tata Steel, Jindal Steel and Hindalco. Now all are metal. So if industry is not doing well, I mean infrastructure is not doing well or industrial growth is not there, then it will not perform well. I am not diversified. But if I have taken Tata Steel, I have taken Nestle, I have taken maybe Infosys or TCS or something like that, and diversified it. I have taken pharma, I have taken electric company, I have taken LG Electronics, like that. Maybe my return is will be better because risk I reduce. So this is very important to know the risk adjusted rate of return. You have seen in the Sharpe ratio also. Now you have shown in the trainer ratio also that even if I take risk, I may not be able to give a better return. So here A was a better performer with low risk, but than B. Though apparently it looked B has performed well than A. So risk adjusted return when I calculate, and that's what one should calculate. A has earned better, B has earned less. Let's move to the next slide. Risk adjusted return, this is the third and final one, Jensen measure. Jensen measure is an absolute measure of performance adjusted for the risk. This is the formula. Model is R, Jensen T and F. A1, RJT is average return on the portfolio for a period T. RFT is risk-free rate of interest. Always RFT is A1 is intercept that measures the forecasting ability of the fund manager. My return like this and my return like that, my return like this and my return like this. So where is the intersection? That is the intercept. From there, I can draw the capital market line. So BJ is measure of systematic risk, and RNT is average return of the market portfolio. E is the error, and this is the ratio. If I put the model, I can get the value. Okay. Uh, in the intercept is AI and has a positive value. It should have. It indicates that superior return has been earned due to superior management skill. On the other hand, if intercept, that is AI, intercept is negative below the year, then that means the fund has not been managed well. Okay, unmanaged fund का जैसा ही हो गया. So no point in giving fees to the manager. In both sharp and trainers model, it is assumed that the intercept is at the origin. Origin means where X and Y, that is where your intercept. In Jensen model, intercept can be anywhere. Okay, including origin, it can be anywhere. That is why if it is above, then it has performed well. If it is below, then it has not performed well. It has unmanaged, some era koi manage kar raha tha. So this is about Jensen's measure, but we mostly focus on Sharp and Trainers model when we measuring some managed portfolios. This is another Jensen's measures you will find. It's just a simple thing, the same thing I am telling you, fund A, fund B, fund C. This is an R data, R FT, risk-free rate is 5, our JT is average is this, and market return is 15, same everywhere. And beta is this. So fund B is beta X. Fund A, the formula you have seen earlier, formula. So fund A is having 2% excess return than the average. This is the RJT, average return. So intersection is 12 minus 10. Here 20 minus 20, fund B is the neutral performance. Fund C has 14 minus this negative return. So in Jensen's measure, though it has given a 12% return, it has given a positive return, it has given 14% return, but it has given a negative return if I adjust for the risk it has taken. So that is what I have to calculate कि हम जो risk लिया है, whether I have got a return against that or not. If not, then I shouldn't have taken the risk. Jensen's measure not only calculates the differential between the actual and expected earnings. Okay. Now, problem with risk-adjusted returns is the use of market surrogate. Always we are using index. So index Nifty 50 use करेंगे या Nifty 200 use करेंगे या Nifty 500 use करेंगे. That becomes a problem. Choice of risk rate, shall I take treasury bill or government of India bond because I am investing for a longer term. So 10 years bond I should have taken. Treasury bills are generally within a year, 90 days, 120 days, like that. So when I'm investing for 7 years, why I am taking risk-free rate as a 90 days? I should also take 10 years risk-free rate. So this type of problems comes. And validity of CPM. CAPM is capital asset pricing model. May not be correct asset pricing model in all circumstances, particularly when information is not available to all at the same time. Many times, capital asset pricing model does not give the proper expected return. Capital asset pricing model gives the expected return from your equity, so equity will be priced accordingly. Now let us come to the components of investment performance. What we find finally, portfolio manager taking a lot of investment policy they have. That means they have to take a risk depending on the client को क्या बोल रहा है. They have to time the market. They have to pick up the stocks based on the risk profile. They have to build the portfolio. Then have to monitor so they can put asset allocation. We call it. So they can give metal sector में इतना, FMCG sector में metal sector 20%, FMCG sector 20%, pharma sector maybe 30%, then IT sector maybe 30%, like that, depending on the risk and other thing. Now, Eugene Farmer says, he is a Nobel laureate, he says, this performance जो हो रहा है, it has a couple of components in it, and then he breaks it down. How much return he has given because of his capability, and how much return he is given because he has taken risk. Risk लेने से तो हम भी return दे सकता है. But how I have selected the stocks and taken the risk. That's important. That's what Eugene Fema says. So it's a long page, but put it quickly. We'll use one example to show how the decomposition means how I break down the return. Mutual fund scheme has offered a return of 15%. Be careful and listen carefully. A return of 15% during a period when the market index, that means RM, is 8%. Risk-free rate is 6%. That means technically the fund has done very well. 15% return diya hai when market has given 8% return. The standard deviation of the returns of the market index and the portfolio are 12% and 10%. Portfolio beta is 0.75. Now you all know capital asset pricing model mein we name expected return is risk-free rate plus beta into market return. The difference of 7.50 can be attributed to ability of fund managers. So ये जो difference हुआ है, that is because of the right stocks you have selected. 7.5% return. Now actually you have got risk-free return. So absolute return 15%. So 9% excess return you have got. Your portfolio has got a 9% excess return, out of which 7.5 you have got because the portfolio manager has selected stocks very well. That's what Pharma says. Now, in balance 1.5 is because of the type of risk he has taken. That makes you 9%. 7 point is CAPM model mein you get 7.5% return. So this is his stock selection. He has neutralized the risk and given this return. But balance 1.5 because 9% is the excess return over the risk-free return you have got. So 7.5 is because of your selection of the stock. Balance 1.5% is because of the risk premium you have earned. Now here I am going again. Keep the figures are here. Risk taking. By using the capital market line, if you remember security market line, capital market line, we can determine the return commensurate with the risk. Because we know if the risk and return goes like this, you increase the risk, proportionately return will be going up. That is the capital market line says. Now the normal return for the fund A using total risk would be, if I use that formula of Jensen's, risk-free rate minus this divided by portfolio divided by market. So 6%, 8 is my market return, 6 is my risk-free return, 10% is my portfolio ka standard deviation, okay, and 12% is my market ka standard deviation. If I work it out, then this return is 7.67 return. Right? So difference between the return 7.67 and the CAPM return 7.50, this is the extra for diversification risk. Right? So this is the extra than CAPM return. I have told two things. One is here, you have got 7.5 because of the diversified portfolio, but that diversification ka time he has taken risk, that premium is 0.17. Now the fund offered 15% return against a CAPM of 7.5. This excess return is attributed to selectivity of stocks. How intelligently the fund manager has selected the stock. However, selectivity increases diversification risk, which was quantified at 0.17%. Removing the extra return for diversification risk. Now, if I remove the extra return because of the diversification risk, actually I have got the return 7.33. बाकी जो return 1.7 वो risk का था. So risk adjust करने से I get 7.33 extra return. So overall performance of a fund can be decomposed into two parts. One due to selectivity and second is due to the risk taken. Selectivity mein I got 7.5, but risk ke liye 1.7 I got extra return. So if I minus that 7.5 say, I get risk adjusted return. That's what Eugen Farmer's framework says. Now we'll come to our last slide. Today we had a long study. We have discussed various things. Value weighted rate of return, it can be rupee, dollar, whichever currency you are using. Time weighted, where every quarter or sub period between the total time horizon we use to find the weighted rate of return, which is much more better, because value weighted it depends on how much investor is investing, on which the fund manager does not have a hand. After that, we studied Sharp model, Trainer's model, Jensen model to know the portfolio evaluation, which I talked in the beginning, first slide. We discussed about problem facing using risk-adjusted measures of the portfolio evaluation. And finally, I have discussed with you the Eugen Farmer's framework that, okay, excess return I have got, but that is actually partly because I have taken risk. If I minus that, I get the risk-adjusted return. That was 7.33 in our problem example. Okay. So with this, we are coming to the end of today's presentation. I hope things are clear and you will get it from your material. You can work and study and repeat it so that your clarity is much better. Thank you. See you again.